Good afternoon and welcome to today's live LBMA webinar. We are delighted to welcome you to listen to Fergal O'Connor, lecturer in finance at Cork University Business School, and Aelred Connelly, PR executive at LBMA, as they discuss gold's place in a portfolio post-COVID-19. But for now, I shall hand over to Aelred to start us off.
Okay, thank you, Taylor. Yes, it's Thursday, it's 1:30, and welcome to LBMA's latest weekly webinar, bringing you all the latest news about how the world of precious metals is facing up to the challenges presented by COVID-19. My name is Aelred Connelly, LBMA's PR executive. During lockdown, I'm glad to say that my moustache has grown out of control. Call me the Dick Strawbridge of the precious metals world. Although at the moment, I'm unable to get to this chateau, the weather here is balmy and it feels as though I have. Anyway, I'm delighted to be joined today in a virtual capacity, at least, by one of the leading academics in the gold market. He's learnt his trade under the guidance and tutelage of Professor Brian Lucy at Trinity College, University Dublin. His research on precious metals began when he was awarded the 2011 LBMA PhD bursary for the study of the London gold market, and he has gone on to publish a range of research on the topic. He is lecturer in finance at Cork University Business School and was previously a lecturer at the University of York. His current research focuses on the operation of the London bullion market from its inception in 1919, as well as the daily price series for gold and silver. He is, of course, Dr. Fergal O'Connor, and I'm delighted to welcome him to join me for what is the 13th, unlucky for some, webinar in our series since lockdown began some 3 months ago. Recent webinars of ours have focused on the contemporary climate in the precious metals market, but today we're going to take a walk back in history and talk about where gold ought to sit within an investment portfolio post-COVID-19. We'll explore questions such as, will gold's role in investors' portfolios change? How has COVID-19 affected gold's performance in comparison to previous market disruptions? And has gold always behaved as it should, as a safe haven? Like Fergal, I'm a firm believer that history has a lot to teach us, not only about the present, but also the future. And just before I hand over to Fergal, one thought: if you're feeling a bit out of sorts, not quite yourself, as most of us are at the moment, there's a saying in Yorkshire, which goes like, I don't know whether I'm in Cork or York.
So hi, Aelred. Thanks for having me along.
But I'm just sorry. So if you, I know that you used to teach in York, Fergal, and now you're firmly ensconced in Cork. So I'm just delighted to give you a warm virtual welcome and introduce Fergal. Thank you.
Thank you, Aelred. Yeah, I was based in York there for about 7 years, lecturing up in the north of England. I moved home about 2 years ago back to my alma mater. My research is all about gold and silver, primarily, after working with yourselves and getting to meet people through the LBMA during my PhD and publishing with The Alchemist. People might have come across some of my Alchemist articles before. And my current research then stems from just finding this old data. So I found old gold data, old silver data, and also, you know, while I was looking, I came across copper data and bits like that as well, but I'm still focused on the precious metals data. Sorry, Aelred, I couldn't hear you there.
Sorry, what kind of sparked your interest in getting hold of this data in the first place, Fergal?
Yeah, so it was a random email one day from Adrian Ash, who I know was on did a webinar with you a couple of weeks ago as well. He emailed asking if I knew where there was gold price data pre-1968. He was looking for, I think it was on the sterling run in the 60s or something like that. He was looking for information on, and the only data around really was annual data, and he wanted it a bit more frequent. I assumed that it was somewhere, and I just hadn't come across it yet. And I remember emailing you, and you pointed me on to the Rothschilds archive. You thought maybe they would have it because they had been the custodians of the gold market when it was formed in 1919. I had some nice chats with them, but it had been lost, so this data was just missing. And there was even a little snippet on the Rothschilds archive website that said the data has proved surprisingly elusive. So it was just, at some point, it wasn't archived, you know, it wasn't put away, and it was just all missing. So it became a little bit of a pet project, looking around for it. And because I was based in Yorkshire, I had the British Library around the corner. It was only about 20 minutes away with their satellite offices up there. And I went there for a couple of days looking through old metal booklets, and I managed to find basically all of the data over the space of a couple of weeks. So all that data popped up from there, and that's where all the research kind of came from then.
Yeah, it's remarkable, really, the lengths you had to go to get hold of that data. So when you finally did get hold of the data, what did you use the data for, and what did it help tell us about the what did the data tell us?
Yeah, well, one of the things I read about it back at the beginning of the PhD in 2011, so I didn't really have any knowledge of the gold market before that. I'd done a master's in finance and all that, but it wasn't a market that it was, you know, you mostly get taught about equities and bonds and things like that. So it was a little bit more esoteric. And one of the things I kept reading about was this idea that the research on gold after, you know, 1968, when the gold window closed, the results weren't going to be reliable forever, because the gold market was rebalancing. Now that it was a free market, the gold price had been fixed for so long, and there was this kind of feeling that any results that you found in your research that used data over that whole period might be suspect, because, you know, it took a long time for the gold market to settle down. So what I wanted to use the data for was to try and see whether or not gold had consistent investment characteristics. So not really in terms of predicting prices or anything like that. That wasn't my aim. It was more to see whether gold has certain characteristics that are useful for investors and are pretty much accepted across the board. So it's an inflation hedge for you in the long term. It diversifies your portfolio because it doesn't have much sensitivity particularly to the stock market, but it's also has a weak enough correlation with fixed income as well. And it's a safe haven, right? So they're the big things that are kind of fixed characteristics in modern.
Yeah, because that's the interesting thing is those kind of we'll come on to talk about this in more detail, but that's the interesting thing from my perspective is how we kind of familiar with those characteristics of gold, and it's whether or not those characteristics have been consistently visible in over time, and we'll come on to that with some questions that we've got lined up for later on. One of the questions that I did want to just maybe start off with was in the 20th century and the early 21st century, we've had various crises that we've had to deal with. And one of the ones that was perhaps most, one of the biggest ones was the Spanish flu pandemic in the spring of 1918. And I just wondered if you could maybe enlighten us as to how that might have impacted the market.
Yeah, so this is the data we gathered. So we do have this period now. If you can look at the first chart up here in the top corner, this starts in September 1919. So that's when the fix officially starts, first official gold fixing. I think it looks like there was kind of more secret meetings once a week pre that, where they would buy and sell gold that was coming in from.
Because Rachel Harvey did a lot of work on that, didn't she? Looking into that, and that was really interesting. And I know that you've worked with her and been involved in that research. Yeah, sorry.
Yeah. But the thing is, it's one of the things that I looked at. So once COVID started, I went looking to see if there was anything COVID-19 related specifically to do with the Spanish flu. But because the gold market was effectively shut up to September 19, so it was a fixed market where it was government control in the United States and in the United Kingdom, there's no bobbling around in the gold price at all. There was some bobbling around the silver price because that market was free, but it wasn't really to do with COVID, to do with the Spanish flu. The other thing that I've gone and found as part of this project to try and put some kind of context with the data is I found the annual letters, Salmon Montague's annual letters, so the bullion bank that would be writing to their investors every year. I found some of those, and then also the LBMA were looking as well, I know. So now we have a complete set, I think from 1913. And they literally never mentioned the Spanish flu. So, and even then I found a few of their weekly letters that they would get published in the Financial Times or the Financial News, which would have been a competitor at the time. And it just doesn't get mentioned. And I think probably the reason for that is the change in the gold market. So gold market today is much more consumer based, much more investment based, you know, jewelry, barn, coin, all that sort of stuff, ETFs. Whereas if you go back to 1918, Gold really wasn't the investment product we think of it as now. And even another thing I've come across in the research is people who bought gold were consistently referred to as hoarders. So it was discouraged. So I don't think there would have been the same reaction because this was still a very much a monetary metal.
Yeah, I mean, I think we mentioned it before that, when it's quite interesting to find out that they didn't really have an impact. Sometimes it might sound boring, but at least, so if we just look at maybe, I know we just sort of touched on it in terms of gold as an investment for investors in previous periods, and we looked at this, we touched on it earlier as a safe haven, having those characteristics. And the kind of question I had is gold, all those characteristics of safe haven for investors, is that a modern phenomena, or is that is that being played out in history as a characteristic of gold?
Yeah, so this was the thing. So the research started, I gathered up the gold data with some funding from the Rothschild Archive. They funded the, so I'm going to say thank you to them. They funded the data transcription. But the problem next became, how do you compare gold to any other asset? Because there's a real lack of daily data going back into that period. So once you go pre-1970, it's amazing how little data exists on any sort of an asset. So what I managed to find was equity and some fixed income data that I transcribed as well, covering this period here. So the graph down in the bottom left-hand corner is the next free gold market from 1931 to 1939. And this is when gold became a real investment product, or became more of an investment product. And you get official kind of Federal Reserve notes talking about people are buying too much gold, they're hoarding too much gold. So this is when
wasn't there a period there? I was looking at your kind of in preparation for the webinar. I was looking at some of your great articles you did for The Alchemist last year to commemorate the 200th anniversary of the gold price. I was kind of like taken by 1929 into the 30s that Bank of France were demanding higher prices for gold.
Yeah, so another thing I was kind of surprised by, because I'd never seen it written anywhere, is if you look at this graph here for the 25 to 31 period, this is a fixed gold price market. Yeah. It didn't operate that way all the time, so it was almost like there was a price ceiling in the fixing. But you can see here the price goes below the ceiling now, not by very much. We're talking kind of fractions of a penny, so it's a very small deviation. And then you get a period here in the 30s where, because there's such a demand for high purity gold, and London doesn't necessarily, because the London market was still on the normal standard that they'd operated on for a long time, there became just a bottleneck. So in the same way that prices diverged from New York prices during the World Wars because of simple transport problems like we've had kind of recently in the gold market, a simple business problem where they couldn't refine gold to a high enough purity for prices quickly enough, it creates this bottleneck where prices go up. So there's all these little nuggets in there where even under a fixed gold price system, it did break out occasionally, right? It wasn't always contained within it. But then, so for these investors, these were their options. So if they were looking to invest in the 30s, this equity index and fixed income index, they come from the Financial News, which merged with the Financial Times in 1945, and it was the first daily equity index going around. So this had 30 shares in it. This had 20 fixed income items. So I just wanted these to try and create some sort of a comparison for gold. And you can see gold during the period is basically going up. The 1930s were a bull market for gold prices. In sterling, they were flat, obviously in dollars most of the time, except when they were revalued. And you can see it was quite an up and down market for the equity index. So post 1929, it did okay, but towards the end of the period, you reach a peak and there's a long bear market. And the fixed income market's fairly flat. But I suppose from what I'm interested in is the relationships between them, and like I said, the characteristics. So was gold a diversifier back in the 1930s like it is now? Does it reduce your portfolio risk if you put it in it because of low correlations? And it looks like it does. So these are the correlations between gold and other assets through this period in the 1930s. For equities, you've got a positive correlation, which is different now. Now it seems to be zero or slightly negative in developed markets. And for fixed income, it is negative, which again is different to now. So now the correlations tend to be zero or kind of positive. But what's important, I suppose, for me is not exactly what the number is, but that these are all pretty close to zero. So these are all very small correlations, and that means that they are going to help you diversify your portfolio. So on a general kind of day-to-day level, over the whole 1930s, you would have benefited from having gold in your portfolio. And then I think your question was more about Safehavens, I suppose. But and then what I've done here is just looked at the 10 worst days on the London stock market up here. So this is the green bar. So you can see here stocks fell 4.5% on this day, 3.5% on this day. And the yellow bars up here show what happened to gold on those days. And you can see the returns. The returns were small, but gold held its value, which is exactly what gold is supposed to do in a safe haven. So I think sometimes there's a misconception that a safe haven is where gold prices rise when stocks fall. That's not the case. It can be flat or very slightly negative. You can't see this one, but it's a little bit negative. And it has a similar relationship then with the fixed income market in the 1930s. So the safe haven definitely appears to be there. There's more research to do on that. So I'm doing more kind of formal research with Professor Brian Lucy on this. We'll have a paper out at some point looking at it more specifically. But even this gives a pretty good indication that on the worst days in the market, your portfolio will be protected by having some gold sitting within it, I think.
Yeah, which it kind of like it sort of leads on to the next question, which I'd kind of framed a question, but we actually got one similar from Suki, and Suki's is actually more comprehensive than my question. So I'm going to ask Suki's question. Suki from New York at Standard Chartered. So thank you, Suki, for this. And Suki's question: is there an optimal level of gold holdings in a portfolio that we should aim for? And how does this rationale? How does this ideal amount of proportion of gold in the portfolio, how does that change when markets are not distressed? Finally, Suki's follow-up question is there a rational case to hold gold when economies are performing well? So you want to take those combination questions?
So I think if you look around the internet, you'll find loads of different estimates of what you should hold as your optimal allocation to gold. So what percentage of your wealth should you hold in gold? And it varies around an awful lot. I think the clearest paper I found on it, because there is no kind of straightforward, simple answer to it, because things change over time. There's a really good paper by Professor Frank McGroarty, who's down in Southampton. He's a professor down there, and he looked at gold from 71 onwards, and he finds that you should have somewhere between 5 and 10% of your wealth allocated to gold, right? You should have that much there. Now, he makes the point that there's a quote by Peter Bernstein, the academic investor who wrote Against the Gods. He says, if you're comfortable with everything you own in your portfolio, you're not diversified. So one of the things you get, so between 71 and I think the paper goes up to 2013, you would definitely benefit on average from having, if you have a fixed amount of, if you have fixed proportions of wealth in different things, you should keep 5% in gold. But there are periods then where gold does badly, post the 80s and the 90s and things like that. And in those periods, holding gold will hurt your returns, right? So it does give you slightly lower returns. And in fact, it even gives you slightly lower risk return relationship, right? So which is what these papers are really trying to do, is to try and see what allocation should you do so that your reward per unit of risk you take is maximized. Modern research definitely, I think, lands somewhere in the 5 to 10%. I've looked at the 1930s. Now, it's a slightly unusual market because it's a short period of time, and you can see if you look at this graph, you have this big bear and bull, but gold is basically positive all the way through. Technically, if you want to maximize your risk return relationship in the 30s, you would have put all your money in gold on the first day and left it there. But that's because you have these two big revaluations, so when gold markets go up in the 30s, the price jumps from £4.50 to £5.50 quickly, and then right before World War II kicks off, you also have a big jump in gold prices from about $7.50 up to about £7.50 to £8.50. So technically, if you were just applying maths without any kind of judgment, you would have put all your money in gold in the 30s, which I think would please some people. I think if you're being a bit more realistic, you've got a range between 6 and 30%, which is quite wide, but it reflects kind of the short period. You only have 10 years of data, so you don't have an awful lot to work with there.
Yeah. Yeah, it's really interesting that because when you look at the last century, there were a lot of kind of pandemics. We had pandemics. We touched on the Spanish flu. There were world wars. We had the Wall Street crash. So there were lots of kind of crises. One that's kind of forgotten is, I think anyway, and it was a colleague of mine reminded me, it was the Asian flu pandemic of 1957-58, which was called H2H2. And I was just interested to know how you thought that impacted on the gold market.
Yeah, and I suppose every time there's something like this, it turns out that the gold price is basically fixed during those periods. So this is the daily price from 54 to 68. This is the daily price from 54 to 68. So this includes that the Asian flu there in this period from 57 to 58. And you can see gold does nothing, right? Gold is just sideways all the way through. It goes up and down a little bit, but that's purely movements in the dollar. Because again, these are pound prices for gold. Gold does react sometimes to crisis. So you can see this spike here.
Yeah.
This is
the Cuban Missile.
Yeah, that's the Cuban Missile crisis. So even though gold prices were fixed, you can see that the price broke out for a short period of time. It went up by about a pound an ounce. So it does react sometimes. It didn't react to the Asian flu. I think the reason is again because it changes in the gold market. So we think of the gold market as now, in terms of all the demand that comes from China, India, and East Asia and things like that. But you've got to remember the economic imbalance that would have been there in the 50s, the relative wealth levels, and also gold was still really a monetary asset. It was still, we were still under Bretton Woods. And people bought gold jewelry, but they weren't really buying gold. There was no gold ETFs. Gold, these things weren't. It wasn't an investable product in the same way in the 50s, even though it did, but it wasn't tradable as easily. So these type of crises don't seem to have affected the price in the same way that COVID has obviously been a big push on prices going north in the last while.
Yeah, I mean, it was like what you were saying earlier. It doesn't necessarily, gold's strength doesn't necessarily have to be that it goes up in price. That it doesn't fall.
Exactly. Yeah, if it's an inflation hedge and all that, then it should be a savings product. It shouldn't be. You had a webinar on Bitcoin a few weeks ago that I watched, and Bitcoin to me jumps around too much to be any sort of a store of value. I know gold is volatile, but it's not that volatile compared to some other assets,
Absolutely, yeah. I mean, you wouldn't necessarily want your pension fund leaping all over the place, especially when you're about to retire. It just whilst we're talking about kind of like comparing the current pandemic to previous ones, there was another one there was the SARS outbreak in 2002-04. And of course, then not a pandemic, but a crisis later that decade, the financial crisis. Could you say a little bit about what the data might reveal about those two?
Yeah. So 2002, 2004, again, I suppose we still haven't reached the period where the Asian market is as important as it is now. I mean, 2002 is when China really starts to open up a membership of the World Trade Organization and things like that. The outbreak also coincided with the invasion of Iraq, so it's hard to separate the two. So there was gold price volatility. Prices jumped. I know they went up, and I think the range around that period was around 16% up and down. But the same level of precautionary demand in Asia probably wasn't there because you didn't have the same Chinese demand, and those economies hadn't grown to the same level as they have now. I don't remember the figures, but I mean, China was certainly a fraction the size of what it is now relative to, let's say, a country like the US.
Yeah.
I think 2008, even though there's no pandemic attached to it, might be more similar for us when we think about gold and what's happening with COVID. Because what matters for gold is uncertainty, right? So it's uncertainty that pushes people into gold. They sell equities, even though that doesn't seem to happen too much. Equities seem to be holding up relatively well again. But what you expect to happen in uncertainty, selling off risky assets and putting your money into safe bonds, into gold, into treasuries and things like that. So I think it feels a little bit more 2008. The prices, you had when the market sold off for COVID a couple of months ago, gold sold off simultaneously for a little while, and that's what happened in 2008, 2009 as well. I think you explained, I didn't know this, that there's that difference in settlement periods where gold settles more quickly than equity.
It's T+2, yeah, in equities it's T+3, isn't it? So you get that kind of, you can use that cash. You can cash out of gold and cover your positions in the equities with a day spare, you know. So it's
Yeah, so I mean, that liquidity that gold gives you, you know, the price went down obviously with equities probably to begin with, but once that initial selling happened where people got the liquidity they needed to meet whatever demands were being made of them, gold since then has been, you know, it's been like, I haven't checked the price today now, to be honest, but it's, you know, the price has been upwards and onwards and upwards. So it looks really similar to 2008 for me. I don't see any reason for prices to go down in the short term with interest rates low and things like that. So, I mean, in terms of me and thinking about gold in your portfolio post-COVID, everything that I've done now in terms of research seems to point to, I've no magic way to predict gold prices, but if you're building a portfolio, you should be putting gold into your portfolio. It gives you diversification, safe haven. In the long run, it'll give you an inflation hedge. And that seems to be consistent. There's another little characteristic gold has, which is that its returns are positively skewed. So you get an unusual number of big positive days in gold in modern gold markets. And I've looked back to 1919 for gold markets. When the gold market is free, you get exactly the same feature, this positive skew. Equity returns are negatively skewed, and that's one of the things that helps with diversification. The positive and the negative cancel each other out somewhat. And you get better distribution of returns in your portfolio. So everything that makes gold useful in a portfolio post 68 appears to have been there, you know, before that as well. And to me, that kind of points to the fact that how do you predict where gold prices will go, and, you know, where will the sources of demand be? Will it be Asia and jewelry and bar and coin, or ETFs? Will ETFs continue to grow? All that, I think, it's an unknowable in some ways, but in terms of how it will fit within your portfolio. So if you're just building your diversified portfolio, gold needs to be in there. Pretty much all research that looks at whether gold should be included in the portfolio says that it should be. The proportions differ. And I think, you know, part of Suki's question as well went to, like, should you be varying the amount of gold in your portfolio? I don't know. I haven't found a way to predict, you know, when prices will move in particular directions. So to me, a good argument to have gold in your portfolio all the time, and just be careful that your allocation is what you're comfortable with. So the bigger your allocation, the more you'll be hurt when the economy is doing really well. Yeah, but equally, the more you're protected then when the economy, you know, takes a beating like it's been doing.
Yeah, I suppose it's a classic case of spreading your risk and not having all your eggs in one basket, and gold is part of your options there to have in the portfolio. So one of the questions that I wanted to ask on a more kind of light-hearted ways is that it relates to the island's national drink, Guinness. And my question would be, how does the gold price relate to the pint of Guinness? So there we have
us talking about inflation in the long run and things, and we thought it would be quite fun. So I went off and I found this was a special just for this webinar treat. I went off a time series of the price of Guinness, and I compared it to the price of gold. So this is the gold to Guinness ratio. So back in 1900, the ratio was just under 0.2. So you were able to buy, 500 pints of Guinness with 1 ounce of gold. So with your ounce of gold, you could set up quite a good party. And you can see then, so when gold was really undervalued and really low priced in the early 2000s, 1 ounce of gold wouldn't even buy you 100 pints at that stage, right? So you had a poor time. But this, you know, the graph says, I mean, I actually think Aelred will have to keep doing this. This will be like our Big Mac index. You know, we'll have the Guinness ratio. Myself and yourself will publish it monthly. But this isn't the worst chart in the world for showing under and overvaluation, right? So this is clear. You know, that late period there, that was clear undervaluation of gold. And maybe back here it's overvalued then when you're buying 600 pints with 1 ounce of gold. But you can see it somewhere here in the middle. And this, if you were to graph the real price of gold long term, it looked pretty similar to this. when you correct it for inflation. All the research says that in the very long run, gold does track inflation, right? But I think the other thing this graph shows is it can spend long periods of time where inflation isn't affecting it, right? Where it should have, it shouldn't have gone this high. It should have been held down.
No, the other interesting thing is that where we are now in terms of the ratio is almost where we were 100 years ago.
Yeah. So I mean, it looks
quite interesting.
According to our gold Guinness ratio, gold is roughly fair valued at this point. I think it could go a little bit higher. You could see the line going down a little bit with gold prices rising. But the one thing I've learned is the price of Guinness rises very consistently over time. It's if I graph that, it's a much more predictable variable, the price of Guinness, than the price of gold.
This could be another ratio that it could supersede the gold silver ratio as the key, the benchmark.
Whenever pubs reopen, I promise to start tweeting out the gold to Guinness ratio for that evening.
So we're sort of reaching that kind of close to the end of our allotted time. The one thing I did want to ask you is whether, we've talked a lot about the data that you've put together and the data that the Herculean task that you had in trying to find the data. Is there any particular sets of data sets or areas of the where data is missing that you need to sort of research and plug?
Yeah, so I mean, you can see there when we talked about the Asian flu in 1957-58, there's no prices there, but there was gold markets active at the time, right? So yeah. London wasn't active, but I can't remember exactly when Zurich started trading to try and take London's kind of gold share and things like that at that stage. I know there were markets in Asia, and the data does exist. So on my travels, I found weird and wonderful bits of data that need to be transcribed. So I found Indian gold prices from before World War II and gold and silver. I know there's Hong Kong prices for the 60s. The funnest data I found so far is gold and silver price data from from 1698 up to 1900 in a document called the Course of the Exchange. But the best thing, and I've some of that data transcribed. If anyone out there has funding they'd like to provide for more transcription like Rothschilds did, that'll be awesome. But the funnest data in that set is definitely the silver price data, because it's not, so you have columns of data with numbers and every day the price and all that. So you've got gold in one column, but the silver column isn't silver. The silver column is pieces of 8. So the silver that was traded in London at that period was the Spanish silver. It was called pieces of 8, the 8-sided coin. So
that's really interesting, because that's the Spanish, like, we associate it with pirates, don't we, of silver coins worth 8 reals, which I think where the pieces of 8 comes from, and I think it had 8 stamped on it, and also I think they used to cut it up like a pie into slices of 8 so that they could break it up and use it in smaller amounts. It's really interesting.
And I think all that, I mean, so I've got a little bit of information now on the 1930s and how an investor would have functioned, but there's the South Sea bubble in the 1700s. How did gold react to that? Gold markets were free from 1668 to 1720-ish. So you get there's other periods of time. There's also the short period of time where gold floated freely in the US and things like that. So there's all these periods that can be looked at to see, are these characteristics consistent? Maybe they're just a 20th century phenomenon, we don't know. Maybe they're a post-depression phenomenon. So the more it's there, the more you can kind of confirm whether this is true. And equity research and things like that, they've done all this. They have a long-run series of data. I think gold is unique that we can actually have the price of an asset from 1698 all the way through to today, and it's exactly the same thing, right? Equities change and bonds change, and you get little contractual differences. But an ounce of gold is an ounce of gold in any millennium. So that's one of the. I think it's interesting to get this long run view.
Brilliant, yeah, that's great. So I think we're kind of reaching that point where we're just over 35 minutes. I think we've reached that point where we sort of have to wrap up. And so I'd just like to say thank you very much, Fergal, for some great insights into the history of the gold market and identifying some areas where more research is required. So that's going to keep you occupied in the future. So all it leaves for me to say is
there's one thing, if there's anyone listening who's interested in using the data for any reason, they can drop me an email. The data is all freely available. I'm not keeping it or selling it or anything like that. Anyone who wants price data or gold price data that I have, drop me an email.
Rothschilds?
So the gold price data is available on the Rothschilds website, on their website. You need to register for that, or drop me an email, whichever's, if people are interested in doing work with it. I know Adrian Ash is using it.
Yeah, and we get requests, so thank you for that, and I'll pass on your details to those who come through to us. So thank you very much, everybody, for listening. Thank you, Fergal, and just to remind you to tune in next week, same time, same day, Thursday at 1:30 to hear our latest webinar. Keep a lookout for details on that, and in the meantime, keep safe. Thank you.
Thanks for having me, Aelred.
Thanks.